Hello everyone, welcome back to Upside Down Data. Today I want to talk about a new risk indicator we just launched for Elrond and its native token EGLD. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter where we put out regular updates about our risk indicators and more. So if you've been following the channel, you're probably quite familiar with this type of graph, but in brief what I'm showing you here is the price of EGLD across time. So each dot here is a day and it's color coded to the output of our risk model, the upside downside potential indicator, or UDPI for short. So the way that you can read this output is that a score of 5 means high risk. That's when the upside potential is tapped out and there's way more downside potential. And a score of -5 indicates low risk. That's when the upside potential is far outweighing the downside potential. Now, as we can see, I should note here that I've plotted price here as in logarithmic form, so just make note of that. But what we can see is that when we look at the price of EGLD across time, the UDPI has done a pretty great job of calling these bottoms, these low risk zones, where historically it's been a great time to be acquiring EGLD, as well as these high risk zones, these red zones, where historically it's been a good time to be selling EGLD. So if one had been following this model and buying and selling based on when it's suggesting it's wise to do so, one would have bought down here and sold up here, which was about a 40 to 42x move. From here to here, which is about a 30 to 34x move. And then from here to here, which is about a 6x move that we just had coming out of the summer. And as you can imagine, just from those numbers, that's pretty extreme. That's pretty darn good. If you're making a 40x move selling and then compounding that times 30 to 34, and then compounding that by another 6 times, one would have made a lot of money following the UDPI across EGLD's history. And so that's what I think is really useful about the UDPIs. It's kind of this leading indicator. It really tells you when an asset has really started to tap out its upside potential and when it's unlikely to be able to move much further up in the future. And then that warns you that maybe your money is better to be taken out of that asset and put somewhere else. So for example, going up here to this big move here in the spring. As soon as the UDPI flashed this deep red, EGLD didn't really end up being able to put in much more work after that. I ended up putting in a slightly higher high than I put in here a little bit later, but it's just very minor. Really its upside potential has really been tapped out. It probably would have needed a good amount more time to consolidate before it could have broken up much more to the upside. But of course, we know that what ended up happening is that there's kind of that market-wide correction, and so EGLD actually ended up crashing down along with it, and that's really when it entered this great accumulation zone again, before it could move up to the upside again. And so really what the UDPI was saying was that in the near term after this move, there wasn't a lot of room for UDPI, or excuse me, for EGLD to probably move much further up in the future, and sure enough, it took another long while and a big correction and consolidation before we were able to move further to the upside. And so really long and short is after EGLD made its move here, your money would have been better in some other asset that hadn't put in its move yet, rather than just holding EGLD for this tiny move to the upside, which was slight, whereas there were other assets that during this time were doing 5 to 10x plus moves, where your money would have been much better put in one of those assets. So another way that we can look at the output of the UDPI is to look at the raw output of the model across time. So what I have here is on the y-axis, I have the UDPI level, so high risk being 5, low risk -5, and then I just have the raw output, and it's just color-coded based on the level. And what we can see is that in those low-risk zones, that's generally corresponded in EGLD's history to this kind of -4 to -5 band. And these high-risk zones have generally corresponded to between this 3 and 5 range here. So you can see the 3 offered resistance twice here, sort of resistance here in this kind of midway through part of that run into the spring. And then, of course, in the spring, we went up all the way here to 5, and that was when we were really tapping out, and we ended up going to that big correction into the summer. So one of the things that's useful about this graph, or just thinking about the raw output of the UDPI, is that it can be really informative in terms of how you might want to consider entering versus exiting a market. So in this case, the market for EGLD. So the way that you can use this, and I've talked about this in other videos in the past, is you can use a strategy that's kind of a weighted DCA strategy, which kind of helps you buffer against any possibility that, for example, we won't ever reach these highest levels of risk, right? So like if you were only selling when we got up to these highest levels of risk, you never would have sold in this move off of the COVID crash up here into mid 2020. You would have just held, and then you would have gone into that correction again that we saw going into kind of the latter half of 2020. You just never would have realized a lot of those profits. You would have kind of missed them if you had only waited to get up to this 5 zone. So instead what you could do is you could say, okay, as soon as the UDPI crosses over, let's say 0, I'm going to take a little bit of profit when we get to here. I'm going to take a bit more profit when you get to here, and then even more profit when we get to here. And then even if we don't get up into these higher levels of risk zones, you'll already have taken some profits, and so you will have taken profits that you'll keep if there's a correction that comes. But then if we do continue to go up, when we get into these 3 to 4 levels, these 4 to 5 levels, then you just keep on selling, and then you probably sell off your entire position by the time you get up here to 4 to 5. And so really that would just ensure that you're getting some profits. So even if we don't get into those highest levels of risk, you'll still have taken some profits. You could theoretically just reinvest them into Eagle, then down here in this really historically great time to be acquiring, and then just ride it up here for that second move. So taking some profits, you can actually compound those as we go up into here, and then you take it in profits, compound those as we go up into here. And so really this is the hedge against just random things happening in the market that you can't predict. You can't assume that an asset's going to always hit these highest levels of risk at every single move it makes. And so what you want to be doing is just making sure that you're taking some profits along the way, so that if it doesn't get all the way up there, you're not left with nothing. You realize some of the profits as you go. And then likewise, as we come down, there's no guarantee that Eagle is always going to have to hit this -4 to 5 range in these accumulation zones. It could only come down to -3 or -2. So you might want to do in that side is that every time Eagle dips below 0, maybe you put in a little bit of money, you start acquiring, averaging in a little bit, average in a little bit more as we get to -1, -2, so on and so forth, and then be acquiring more heavily as we get to these lower level zones. So that even if we don't make it all the way to these kind of bottom zones, you're at least being able to acquire some to ride the next move to the upside. So none of that's financial advice. It's up to you to make your own strategies, your own decisions, etc. But that's just one way that the UDPI can be helpful to inform these kind of accumulation and distribution strategies, where you can have an idea of where the asset is, what the upside versus downside potential ratio is, but then also ensure that you're not missing out on a move just because we didn't get to these most extreme zones, because of course that's not guaranteed. It happens, and we have seen this happen before, and I wouldn't be surprised if it happens again, but it might not. We might only end up getting up to 3 in the next move, for example. And so the idea is you just might want to have a strategy that allows you to take some profits instead of just kind of betting the farm on us getting to these high levels of risk, but we might never actually get there. So again, not financial advice, just something to think about. So to talk a bit more about where Eagle is today, this is the current level of risk as I record on October 30th. So we're at 0.24, which suggests that the upside potential is still slightly lower. It's still slightly less than the downside potential, so the downside potential is still outweighing the upside slightly, but it's a relatively even risk-reward ratio right now. The upside potential and downside potential are about similar. It's quite even. And so it would suggest that it's not a historically fantastic time to be acquiring EGLD right now, but it's also not a historically bad time to be acquiring it either. It's kind of in the middle. And what we talk a lot about on this channel is that it's useful not just to have these indicators for one asset like EGLD, but also to have them for a variety of assets in the crypto space. And so on this channel, we have UDPIs for a bunch of different assets now, that and we're adding them, more and more every week. We're adding more and more of these indicators. So we have one for Bitcoin, one for Ethereum, one for ADA, one for DOT, Atom, XRP, Link, and HBAR. And now we're adding in EGLD. And one of the things that's useful about having this is that you can compare on a glance the risk reward of different assets, and then think, if I'm going to be putting money into the market, and I don't really care too much about which project it is, I just want to get the most favorable risk reward proposition at this current point in time. It just makes it really easy to select out the ones like ADA, HBAR, and XRP, which currently seem to be offering fairly decent risk reward propositions, more upside than downside potential. And those might be a little bit more pleasant, more appealing right now than EGLD, which is kind of in the middle. But then, of course, EGLD is more appealing than something like Ethereum, Bitcoin, DOT, especially here, and Atom, which are a little bit more overheated in this current moment. Now, of course, none of that's to say that any of these projects are fundamentally better than the others. That's up to you to decide which one you think has better fundamentals. This is just more in purely the risk-reward proposition right now, what the model thinks, which one's offering a better risk-reward ratio. And currently, EGLD's kind of in the middle, it seems like, right now. And another thing that's useful about these indicators is, let's imagine that EGLD went on a crazy rally. You know, we spiked up to these 4 or 5 ranges, and it's really suggesting that EGLD is kind of topped. What you can do then is you can say, okay, if it's time to be exiting EGLD, where should I put those profits? You know, is there another asset that has a low risk currently where I could potentially put my money in there and then ride it as it makes its subsequent move potentially? So if EGLD moves before some assets, you can then take those profits, move them into a low risk asset. So let's imagine, let's just say ADA was a low risk one at that point in time. You can put those funds into ADA, and then if ADA hadn't run yet, maybe then it's going to run, start realizing some of this upside potential, and you can then compound your profits. So you've taken profits off of EGLD, and you now can compound those even more in a second asset, like maybe something like ADA. So that's one thing that's really useful about having these multiple indicators, is that once one overheats that you have a position in, you know that you should be taking profits. You can then decide where to take those profits into and then ride the moves of those other assets. And that's when you can really start compounding profits and turn something like, let's say, a 5x move. Let's say EGLD did a 5x move, got it up here, or higher 10x move. You can then take that and then ride another big multiple move in a different asset after that. And that's how you can really start stacking those profits in the crypto space. All right, that's what I wanted to talk about today, so thank you for checking out this video. Remember to give the video a like, subscribe to the channel, and follow us on Twitter, where we put out regular updates about our UDPI levels. And we'll be putting out more updates about EGLD on the YouTube channel as well, about its UDPI level kind of over time, as well as introducing more and more risk indicators as we put them out, and updating other current risk indicators we have. All right, thank you. And remember, with the UDPI, we're all going to make it.